So one of the biggest problems at startups of things going wrong, founders think that it's investors that are going to fire them. It's actually founder fallouts. So the 95%, at least in early stage startups, problem, and maybe 20% of the time founders fall out. And if they don't have stock with reverse vesting, it's a disaster because the departed founder owns 50% of the company's uninvestable. So you have to have the good and bad leaver clauses and so on. And then you have to take a bet. How long does the stock vest for?
Hey everyone, welcome back to the Ignite podcast. Today, we're thrilled to have Anthony Rose. He's the serial entrepreneur who took BBC iPlayer from skunkworks to national pastime and now helps 60,000 founders raise capital faster as co-founder and CEO of SeedLegals. Thanks for coming on, Anthony.
Thank you so much for having me on the show.
Yeah, so back in 2008, 1 out of every 5 UK internet clicks pointed to a new tool called iPlayer. The architect, you. 10 years later, you asked, why is fundraising still stuck in dial-up? And you built SeedLegals to fix it. Let's unpack that leap and maybe get the origin story.
My background's actually electronics. When I was a kid at school, I had a robot pick-and-place machine and a hot belt surface mount machine at home. And I built an electronics manufacturing business in the days before angel investment and VC. I was living in South Africa. And I learned that you actually had to make money to build your business. If you didn't get more money coming in at the end of the month than you were spending, you were out of business. But then things changed, of course, in the invention of VC and investment, which was great. But then left South Africa, moved to Australia, got hired by the folks who then became Kazaa. They got involved in music file sharing, building a licensed music store. And then one day the BBC called and said, how would you like to join the BBC? And I went, sorry, where are the stock options? Because it's a public service broadcaster in the UK. But I was persuaded to leave Australia and move to the UK, which is where I am, as we talk today. And when I joined the BBC, iPlayer had been something they'd been working on for ages. For those who don't know, iPlayer, it's like the Hulu or Netflix of the BBC. It's used by millions of UK viewers every day. Good fraction of TV viewing in the UK is now, of course, online and on your phone. And the BBC had been noodling over this for a while, not doing a great job on it. I think it was more like an R&D, as you said beautifully, a skunkworks, and it needs really to be productized. And that's really where I guess I learned the set of things that are now commonplace, and you buy endless numbers of startup books on agile fundraising and customer-driven development and so on. And actually, I didn't know any of that stuff at the time and made it up as I went along. And one of the things I did was what I call Anthony's chocolate box test. So when I joined, the product didn't work very well. And pretty much everything you tried had some problem. And I went to the dev team and they kept telling me, dude, it's just you. You're the only one who's using Microsoft Explorer with this combination of graphic card and this program. And I realized there were 100 things didn't work. And if any one person experienced this only one time in 100, for most people, it's never going to work. So they didn't believe me. And so I needed to do user testing. So I went to the BBC's testing department. I hunted them down and said, I need to do some user testing. And they said, yes, we can do that. Cost £20,000, takes 6 weeks. Where do you want to start? And went, there's no way I'm spending £20,000. And I don't have 6 weeks because my product launches in 3 months. It's not going to work. So instead, I went to the local supermarket and said, and bought some big boxes of Lindt chocolates, those deluxe editions. And then I went to non-technical folks at the BBC, i.e. the legal department, and said, if I give you this big box of Lindt chocolate, will you come down and test my products? And they said, yes. So I got all the developers in a room, big screen TV, and then got this person to go and do some user testing. And the first time it was a disaster. Nothing worked. Everyone's faces were on the floor. I went, okay, what we're going to do, we're going to pick the top 3 things that were broken, and we're going to fix it in 24 or 48 hours. And then we're going to repeat. And actually, by the 3rd time or so we repeated, it worked. It was great. So then we could go and launch. And for me, this experience of customer-driven development has changed and drives everything, which is, I think, a big problem founders make is they talk to their team and they sit in their office and they build stuff and they don't talk to real world users. So you want to bring those users as close to you as possible. But I completely digressed from your question. And after I left, then it was time once iPlayer was delivered and growing, left the BBC, built a startup, sold it, built another startup, sold it, invested in a few, got tired of paying lawyers, met my co-founder, Laurent, who's a genius, ex-VC and serial angel investor. We met at a fabulous party in Rome held by an investor in my previous startup. He was saying those fundraising legals, going to lawyers, it's broken. Lawyers take forever. They make mistakes. They charge a fortune. We should change it. And having built and sold a couple of companies and looking for my next gig, we thought, let's get together and do it, which we did. So that was like 7 years ago. And now a good fraction of all UK startups are on SeedLegals as the platform, to get investment ready, to all those founder agreements, table funding rounds and beyond.
Oh, amazing. So in your opinion, when you look back, 7 years ago, what was most broken about the fundraising process, and what did SeedLegals solve with its platform?
Great question. And I think at the time, I thought my goal was to build legal documents faster. But I realized retrospectively, no one actually wants legal documents. What they want is find investment or find investors or a general empowerment that as a founder, you've got many, many things to do. So on a rainy Sunday night, is there a platform you can log in and it'll do the stuff you want? So if, what I joke to my team about is think about what a law firm does, and we're going to do completely the opposite. So the product is not a legal document. It's a video on the things you probably want to know about. It's data to show you what the common deal terms are, so you're not the sucker in the room. It's an always-on platform. There's no billable hours. It's a fixed price and always-on SaaS platform. And oh, by the way, it's a legal document as well. So my goal is think what a founder will, putting this more widely, think about what your customer ultimately is looking for, and then have the website going, this is a problem you've got, this is the solution to that problem, and then figure out what's called, I guess, a man and machine or people and platform interface. So you can use technology, but often people want to talk to a human. So the platform will build all the legal docs that you want. People go, well, my investor, they want preference shares and this valuation. Do you think that's a good idea or not? So, of course, you might have a video on it, but they still want to talk to a human. So, we have team and platform. And I think that's what the formula that I think our customers really love.
Interesting. So it's not just, okay, here's your, name your favorite platform, like AngelList or Carta, like here's all the stuff to do all this, all the software to do all this legal stuff, but really you have, agents that you can talk to and actually get advice.
Exactly, because, the reality is the creation of a safe or a cap table, these are trivially easy, right? What you really want to find out is, my investor says my 10 mil valuation is crazy. Is it just them or is it me? And you can have data, but, often people want to talk to you. And also, stuff goes wrong in a startup. My co-founder and I just not getting along. Well, okay, great. There are WhatsApp groups for that. Maybe you need to get a couch. But, where do you start? So we like to be there when things go right and when things don't go wrong, and be generally helpful for the set of things that people want. But be able to do it, of course, in a scalable way, because I have a business to run and want to be a platform business, not a law firm as well.
So it sounds like, do you guys compete with kind of the AngelList, Sidecars, Cartas of the world? If so, like how do you differentiate? And if not, like what's different?
Sure. So in the UK, we don't bump into them because they're really not in the UK. And essentially in the UK, it's SeedLegals, which is great. But now we're in the US as well. And I spend half my time in New York and half the time in London. If half the UK startups are on our platform, that's great. But if we want to expand, we need to go further. So we've looked at, what's the gap in the US market? I think people have kind of described one way is to say it's Carta with legals, which I think is not a bad description. So my goal is the all-in-one platform with people you can talk to. So, what we discovered quite quickly in the US, is that cap table and safes are highly commoditized. I mean, you can get them anywhere. You can incorporate a company and it comes, cap table and safes. So there's nothing special about that. But after that, you're stuck, right? So those agreements that you need to grow your business. When you want to do a price round, there's no one that is productized a price round. There's no one really educating you on finding investors, the tax benefits, which I'm sure we'll get to in a minute, what happens when things go wrong. And so as we are now expanding in the US, we're covering the things that you need as you grow your company. but also actually really interestingly finding the gaps that others have left on the table. Is that the right metaphor? So, for example, about a third of companies we see are LLCs, and no one has productized the LLC to C Corp. So investors aren't going to invest in an LLC because it's a pass-through tax structure. They don't want those problems. They don't get QSBS and other tax benefits. So you need to make it a C Corp. But where are you going to go? And half the lawyers you meet are going to go, well, you see, we know Delaware, but we don't know Wyoming or whatever. And the other half say, we know Wyoming, but not Delaware. So if only there was a low-cost, easy, productized way of flipping an LLC into a C Corp. And so that's the very next feature that we're building.
Yeah. Why do you think the productization of price rounds has not happened? I mean, a big reason the SAFE came into being, was invented, was to accelerate the funding rounds of these, seed stage startups, right? And kind of, make it so, hey, let's not go through all the legal process of doing the shareholders agreement and the stockholders purchase agreement, all these things, right? Why do you think we can't get priced rounds as easy as SAFEs?
Okay. So I think here I bring a unique outsider perspective. And I'm not a lawyer. I'm a product guy, right? I build media things.
And none of this is legal or tax advice.
Yeah, well, I employ lots of lawyers. Initially, I was a bit embarrassed, like I'm not a lawyer, but now I'm really proud of it because you get to see things in a whole different way. And the other outside is because I, come from the UK, I get to see one pattern and then a very different pattern. So let's dive into it because it's quite interesting. So in the UK, founders just interchangeably raise with safes or the UK equivalent or a price round. They just go, my investor wants a price round, I'll do a price round. Or safes are stacking up, I'll do a price round. Actually, I've only got a few investors lined up, I'll just do some safes. So in the UK, legals, thanks to SeedLegals, are incredibly inexpensive. You can do a price round for like $3,000. So there's no difference in a founder's mind. They're just two tools that you flip between, and they each come with different tax advantages and benefits and dilution and so on. But what's happened in the US, my take as the outsider, is that for years, the cost of a funding round was huge. It was like $50,000 to $100,000 that lawyers in the US charge for a priced round. So YC came along going, here's a simple document like an IOU that just kicks the can or the ball into the long grass and says, forget all this complex, expensive legals. I'm just going to promise you shares later. And it's a great idea, but it comes at a cost. So for investors, they're not getting shares now, they're getting shares later. If the company never fundraises, they never get shares. If the company goes out of business, because they didn't get shares, they don't get to write off their loss relief, which they would have gotten had they gotten shares. And also, in return for the founders, I see post-money cap safes. Every time you go to an investor and you take their investment, you're promising them non-diluting equity up to the point the safe converts. So if I meet you and go, okay, Brian, you're investing, $500K on a 5 mil post-money cap, that means I'm promising you 10%. And then I meet Alice and I promise her 10%. And I meet Charles and I promise him 10%. I've just given away 30% before I get to convert them in my next price round. Whereas if I had done a price round, everyone would share in that dilution. And so what's really interesting, if you run the numbers, and I've run the numbers because I think there's a big market gap there that's killing founders, is if you're giving away 15% each in 3 rounds with safes and then doing a price round, the difference between that and just doing 1 round of safes and then raising with price rounds is, in one case, the founders have got 45% equity, and then the next they got 55%. So it could be the difference between you having majority ownership of your business and having lost majority control. So I think founders don't really think about it. And so imagine that actually it was so easy to do a price round that you can now flip between it. So realistically, you're probably still going to do safes for your first round because, it's super easy, super inexpensive. You don't know the valuation yet. But when it comes to the next round, you're actually much better off converting those last safes. Basically, anytime your valuation is higher than the cap on your last safes, you're better off converting those safes than keep raising at a higher cap. and having these lower cap ones that are going to get more dilution. Of course, to change the status quo, because it's super easy to do safes, you need to make it really easy for founders, attractive for founders, but also investors. There needs to be something in it for them. Otherwise, they're going to go, well, I like my non-diluting shares, please. So there are two things for investors that make it attractive to get shares. The first one is QSBS, for those who don't know it. I'm quite surprised that lots of people don't know about it, which is for an investor, if you keep your stock for 5 years, you pay no federal capital gains tax up to $10 million or 10x the amount that you've made as a profit. And in many states, you pay likewise no state capital gains tax. And now with the latest changes, if you keep your stock for 3 years, you get a 50% tax benefit, and 4 years, 75%. But the jury's out, bizarrely, and if the investor could get their stock immediately, they could get these tax benefits for sure without, maybe years go by and the 5-year clock starts ticking. And the other thing is a good fraction of companies sadly go out of business. And in the UK, there's a fantastic tax loss mechanism that all angel investors use. In the US, there's something called Section 1244 that almost nobody knows about. And it basically says if you're the first $1 million into a startup, the startup goes out of business, you can tax deduct you can take $50,000 a year or $100,000 a year in the year in which the loss was realized from your taxable income. So if you're a VC, this is irrelevant to you. But if you're an early stage angel investor, or you're coming in with an angel group taking 50 grand a year, I mean, if you're investing 50K tickets, you can get back, as a loss relief, a good fraction of your investment.
And why this is important is it can actually offset your ordinary income, right? Like, so if you're a highly paid executive and you make, $1 million or $2 million a year, and you're writing 25, 50K checks directly into a startup, and you're getting shares, and you lose those shares, you don't write off those losses against other capital gains. You get to actually write off against higher tax ordinary income, which is an important distinction. So it could be, in certain cases, a very lucrative write-off.
Exactly. And so just to jump in on that, so, I mean, not that we're doing legal and tax advice here, but, normally if you lose money on investment, it's the deduction in your capital gains tax, which means you have to have made a capital gains tax profit in that year.
Or you carry those forward until you have it, right? Yeah.
That's right. Whereas here, it's off your income tax, so it's advantageous. But it only works if you've got stock in the business. So if you've got invested with a safe, the safe has had to convert beforehand. So I'm thinking there are two opportunities here, actually. Opportunity number one is to help investors with what I'm calling a safer. Instead of investing with a safe, imagine there's a vehicle, an instrument that's pretty much as easy. The difficult bits are now all automated. The investor gets actual stock, not a promise for stock. And for the founder, there's actually not much schlep involved compared to doing that. And they don't have the same non-dilution stacking build-up. So I'm working on that, the safer.
Yeah. Maybe something that's like as easy as a safe, but it gives you preferred shares as of this date, that you sign this thing. You actually have, we're authorizing some simple millions of preferred shares, and it's just as easy as that. It's just like, it's almost like synthetic shares. They exist, but they don't really exist. We'd have to get some legal scholar to kind of look at this, but yeah.
Well, I think they can actually exist. I don't see the problem with them existing.
Well,
you've got
where
to
do shares really exist, right? I mean, they're all just figments of our shared imagination, but they're on a document, and we agree that they exist because you're issuing them. But yeah, I wonder why we just haven't gotten dead simple with share distribution like that.
Yeah, well, it's because people have been doing things in a manual way for ages, and computer can change that. So what YC did is they went, we're not going to try and change all this manual stuff. We're just going to make a new piece of paper that says you're going to do all this other stuff later. And I'm saying, I've got a platform. I can automate all this other stuff. So, to your point about when are shares created, actually, to the best of my knowledge, they are actually created when you file with the Delaware State Registry, assuming you're a Delaware C Corp, the issue of the shares.
I'm issuing shares. Yeah.
Yeah, and so it's the actual using a registered agent to file it with the state registry. At that point, they exist, and until then, they don't exist. So if you can make that whole process super slick and easy and inexpensive, then I think you've got a game changer. So the other thing is that there are millions or hundreds of thousands of investors in the US, angel investors whose, some of the investments, maybe like 80% of them have gone to zero. And I think they've all lost money, but they haven't done anything about it to get it off their taxes, probably because either they didn't know about Section 1244, or maybe it was just like too hard. Like, where do I start? What do I deduct? I didn't have stock. Can you automate that? So I'm calling that Seedback. It's my next project, which is if you're an investor and you've lost money on an investment, and you know how sometimes you road test an idea and people go, I'm not sure about that. But product market fit is like when everyone you talk to goes, you know what? Actually, I lost 10 or 20K on my last investment. Can you get that back for me? And pretty much 100% of the time I talk to an investor, they go, oh, no. So actually, good timing. So I need to go finish building that.
Yeah. And so the mechanism for that would be angel check. We're going to convert you to shares and then write off the shares, more or less.
Exactly, that's right. So the company needs to do this. So it's a bit more complicated because the company needs to want to help, but you need to realize the loss. So if the company's gone out of business, there are basically three possibilities. You've invested with a safe and the company's gone out of business. Bad news, you've just lost your money. Option number two is you've invested with a safe or the safe's converted or you've got stock in the company's gone out of business. Good news, you can deduct that loss. Possibility number three, which is probably the most common, is you've invested in a safe, the company's just gone to zombie mode. Nobody bothers shutting down the company, they're just doing nothing. And the problem now is you don't have stock, so you can't lose anything. If you leave it too late and convert the safe into stock, the basis at which the stock is issued is zero. So when your stock goes to zero, you haven't lost anything, so you can't deduct. So what you want is you want to be able to convert your safe into stock while the company still ostensibly has a value, and then it goes to zero afterwards. But how do you prove it goes to zero? Well, one way to do that is the company buys back your stock for a penny, or somebody else buys your stock for a penny. So there are a few pieces in this puzzle, and if you can productize and automate that and make it easy, I think what's interesting is there's a viral effect as well. Let's say, you've lost money and you call SeedLegals and say, help me get my money back. Well, everyone else who's an investor in that company can benefit from the actions from that. So, you then reach out to all the other investors. Anyway, I've got my homework to do on that, but I think there's a really interesting product there.
And then, for 1244, Section 1244, this writing off ordinary income, you have to have shares. Do you have to have it for a certain amount of time, or could it be like even a single day? Like you got issued at $1 a share and now you write them down to zero the next day?
I believe you just have to have them for a day. But when the shares were issued to you, they had to have a value. They couldn't have been zero value at the day, and then later on that you sell them for zero, or the company goes bang afterwards.
Yeah.
Yes.
What else are you discovering about the U.S. market now that you're kind of, you kind of developed this, leading platform in the U.K. and now you're entering the U.S. market? Like, what other kind of peculiarities are you discovering here that are surprising?
It's a great question. I think in the UK founders eye the US, right? We read TechCrunch. They're crazy numbers. People raise zillions at insane valuations. Everyone's very much jealous and eyeing the US.
I'm an OpenAI executive and I left and I raised, $2 billion on 10 billion pre-product, pre-revenue. It's like, what?
Exactly.
Yeah.
So is it like that? And now I'm spending time in New York. You realize actually the fundamentals are the same. The 99% use case is there's some founders that are scrappy or hustling for investors. They're chasing angels. Angels are saying, yeah, I'm in, but find a lead investor first. Lead investors saying, love what you're doing, come back later because you don't have revenue. It's kind of the same formula everywhere. However, there is definitely more money. So in the UK, your first round might be raising £250,000. In New York, it's raising $1 million. Maybe in the Bay Area, it's raising more. So I think the fundamentals are the same. I think I do see people who are more ambitious in the US because you're just not going to easily get the money. I was talking to a founder a couple of days ago doing humanoid robots, robotics at Mercedes-Benz, and now looking to raise 25 mil because, hey, I need that because building robots is expensive. If you did that in the UK, it's not going to work. Do it in the Valley, probably will get that quite quickly. So I love that unbridled ambition and scale in the US. But otherwise, I think the formula of had to go to lawyers, which is going to change. And when we started, for me, it's interesting because at SeedLegals, if I go to a startup event in the UK, most founders are actually on our platform, and most founders will know me. And I go to an event in New York, and like nobody knows SeedLegals and nobody knows me. And so my metric is how few weeks can go by for that to change, at least for people to know the platform, even if not on the platform. When we started in the UK, everyone went, well, we use lawyers. Like, why would we use a platform? 7 years later, like most startups are on a platform and only use lawyers, for other things or much later on. When you have a startup and people are behaving in a particular way, does that mean one or two possibilities, right? Either technology is going to change it, and a little while later, everyone's going to operate in a different way, or actually people operated that way for a fundamental reason, and technology is not going to change it, right? So for me, the playbook in the US is like, okay, if I just rerun whatever we did in the UK, in the US, will it get to the same outcome, hopefully faster? Or is there any fundamental difference? As a startup founder, and I'm making this generic for everybody, it's a fascinating problem because, if you don't believe that you're going to change things, it's not going to happen. But if you're naive and keep beating your head against the wall and not looking for simpler solutions which will take off faster, you could be the guy who invented apparently the intermittent windscreen wiper, I think, like sued the auto manufacturers for 20 years for patent. I mean, I would have given up after like a year. It's like, dude, this is insane. You've got to do something else with your life. And eventually, like 20 years later, they got a payoff. At what point you go, we're going to change. And by the way, I'm not suggesting this is anything that needs to be changed. I love the uptake and I love how founders are already changing the way they behave with price rounds. And I love how founders using SeedLegals for price rounds have just inverted the we'll wait for an investors to send me a term sheet, right? Because that's what I hear. Price rounds, the investor's going to send the term sheet. But actually, we just see people getting on the platform go, do I want to say for a price round? Actually, I've got 4 investors. I'm going to set the deal terms. I just push these buttons and I'm going to send you the documents and we're going to do a price round because we can do it almost as easily as a safe. And I think that's how technology and empowerment changes everything.
What are your thoughts, post-money safes versus pre-money safes? Because my problem with pre-money safes, and I've actually backed out of deals because of this. Founder be like, oh, I'm only raising a pre-money safe. And I explained to them like, well, that's all fine and good, but then I don't know actually what I'm getting. You can keep raising money and diluting me forever before you actually convert. How do you advise VCs like me and founders on post-money versus pre-money safes? I mean, of course, we all want to do priced. Let's get there as fast as possible. But like you're in the pre-seed and seed rounds. Like, yeah, okay. I'd love to get your thought on this debate because you've thought really deeply in this area.
Okay, so now let's start to answer that with another difference between the UK and the US. So there's actually 2 completely different patterns for fundraising in each. So in the UK, there's these fantastic government tax benefits for angel investors that say if you keep your stock for 3 years, you pay no capital gains tax. If the company goes out of business, you can write it off. And even better, you can tax deduct immediately 50% of your investment from your income tax. Invest 50K, I can deduct 25K from my income tax. It's awesome. So 80% of all investment, early stage investment in the UK is these tax benefits. But if you invest with a safe, or the UK equivalent, there's a rule that says you have to get your stock within 6 months. In other words, it has to convert within 6 months. So as a result, fundraising in the UK is raising with safes with what's called a long stop date that says, if I do a funding round in 6 months, you get your stock. If I don't, it's going to convert in any way at this cap or long stop valuation. And so the pattern
so it allows
in the
you to
UK,
kind of get the money right away, but we'll spend the next 6 months kind of finalizing the conversion.
Exactly. So in the UK, safes are kind of a bridge to the next round, whereas in the US, they are the next round. And so because safes will convert reliably within 6 months, one way or the other, the pattern in the UK is a discount rather than a cap. And actually, they converted to pre-money valuation because not much is going to happen in 6 months. Whereas in the US, it's like, well, you're going to kick the can down the road.
Yeah, you could have 4 or 5 years of pre or post money safes before you actually convert. Yeah,
exactly. The investor in the US wants to protect themselves because you don't want to be the schmuck that's like investing today at a valuation of 5 years later. I mean, if I want to invest at a 50 mil valuation, I'll wait 5 years. Otherwise, I just want my valuation today. Post-money cap is the solution to promise me a certain amount of equity and then give it to me any number of years later. But that doesn't have to be the only formula. So I think the post-money cap, where you're promised a fixed percent equity, as opposed to pre-money cap, which is where you're saying at the time it converts, it's going to be at this pre-money valuation, and I'll, share that with all the other investors in the round, all the other folks converting. It's a solution to a particular problem. And the problem is years may go by before I get my stock. And so it makes sense. Whereas in the UK, forget the cap, just give me a 20% discount on the round.
I'm getting my shares in 6 months,
Exactly. Give me a 20% discount and I'm in, which is actually a kind of a safer thing for a founder because they're not going to end up doing a way high valuation, giving someone a terribly low cap because they didn't think about it. And for the investor, well, what if the founder overshot the valuation and is raising at a lower valuation? Actually, I get a discount, so I'm good either way. So it's interesting that there are multiple coherent patterns that exist. And here, I think, is the interesting thing, which is now as an outsider seeing the US, there is a different coherent pattern that hasn't kind of been on people's radar because it was expensive and complicated. But if you can remove that from the equation, you can have a new pattern, which is raise fast with price rounds, give everyone their tax benefits, give everyone their stock, but also do that in a way that founders don't lose control of their business. Because I think founders fear investors are going to own the board, and like Sam Altman, you're going to be fired by your investors and so on. But what we've seen in the UK, it's exactly the same with the NVCA funding round documents. They're actually highly parameterized, which means how many board members would you like? How many directors would you like? Which things need investor consent? And so by empowering founders, they really need to know what they're signing up for. Because otherwise what happens, we've seen people spend fortunes on lawyers, get back 200 pages of legalese. You have no idea what's in it. And then you find yourself signing some things, and then you discover you kind of like lost some control of your company. You need investor consent for too many things, or there are more investors on the board, or there's the same number of investors, but they've got a veto right. So how do you help founders understand what they're signing up for? And how do you create this sort of lightweight things in early stage rounds? And that's really one of the things I love doing. And by the way, as I said, I'm not a lawyer, but I love what I do. Something that investors often tell founders is, fall in love with something and then go build it, or love something and then go build a startup.
Love the problem, yeah.
But it often doesn't happen that way. I mean, I don't think you wake up, certainly I didn't wake up going, you know what, I love legal automation. No, I love solving a technical problem which involved making legal documents. But then what you fall in love with is your customers valuing and loving your service. And so now, I think of legal documents as the manual in your car. So you buy a car, it's fancy. You're driving along on the highway and it breaks down and something's gone wrong. And so you open the glove box and you take out the manual and you go to read it, and it should have the answer. And what I like to do is build the manual for when things go right and go wrong. So one of the biggest problems at startups of things going wrong, founders think that it's investors that are going to fire them. It's actually founder fallouts. So the 95%, at least in early stage startups, problem, maybe 20% of the time founders fall out. And if they don't have stock with reverse vesting, it's a disaster because the departed founder owns 50% of the stock, company's uninvestable. So you have to have the good and bad leaver clauses and so on. And then you have to take a bet. How long does the stock vest for? So what I like to see is when, people call us, that's where the humans come in. Hey, I've had a fight with my co-founder. What to do. And we go, well, kind of open the glove box, like take out your stock purchase agreement or your company's certificate of incorporation or bylaws, let's look at what it says, or the voting agreement and so on. Let's look at what it says. And okay, great. You're 1/3 into a 3-year vesting period, so you've got to give back 2/3 of the shares. If that works, great. And if you don't have those agreements, it's kind of pistols at dawn while you try to figure out an amicable answer. And if the founders are cooperative, great. And if they're not, it's a mess. So to me, it's all about looking at what goes well and what doesn't, and having the manual that you can open and it has the answer when shit happens.
It sure does. So, SeedLegals handles thousands of cap tables. Any interesting trends that surprised you over the last year or two?
I think that people using in the UK safes instead of a funding round is probably a trend that's probably less interesting for in the US. But what happens is, because these safes in the UK for tax purposes need to convert within 6 months, the intent was, I'm going to do a funding round in 6 months. But now people are going, well, forget that. I'm quite good at raising with safes. I'm just going to convert them in 6 months without even bothering with the funding round. So I think that's an interesting trend. The other trend, of course, which is universal, is people not doing their next funding round and doing a top-up or a bridge because the valuations aren't there, or you can't raise the amount you want. I think that's an important trend. And I think the other one, which is not fundraising but is startups, is I think you used to have bragging rights if you had more people in your business. And that is changed. I think bragging rights is having fewer people in the business.
Revenue per employee, seed strapping.
Exactly. And I think people talk about bootstrapping and so on more. So once upon a time, if you said you've got 200 employees, it was a badge of honor. Now when people tell me they've got 200 employees, you're going, well, could you do this?
Yeah.
Exactly. Can you use AI and make that fewer? So what can you do with fewer and AI? So it's obviously about efficiency in a company. And by the way, separately, and here I'm going to get myself in trouble, which is, I love the Twitter threads about, the one-person unicorn company. Can you build a unicorn with just one person? But unless your goal is to get in the history books of doing that, I think it's a wasted endeavor. It's a pointless goal, because the reality is there are endless amounts of stuff you have to do in a startup, right? I mean, apart from tax filings and talking to founders and doing compliance and writing the T's and C's.
I think it'll be 5 to 10 people, and they'll have functional heads, right? There'll be a head of marketing, and the head of marketing will have a swarm of agents doing all kinds of marketing tasks, and coordinating all the marketing tasks. But it's really the head of marketing who's sitting there worrying about that 8 hours a day. I think that's a more realistic future scenario. I think the one-person startup, the one-person unicorn, is an interesting thought experiment. It kind of captures the imagination, and I certainly think it is possible. And I do tend to agree with the San Francisco consensus of 50% chance by 2030 that happens.
Yeah,
you're already seeing this, right? You're seeing companies bootstrapped to hundreds of millions of revenue without raising venture capital. So I think the whole industry is really changing right now.
And I think it's a fun thing to observe. But I think it would be a poor goal for a founder, because the reality is, if you're getting 100 million a year in revenue, the cost of hiring and having 100 employees is just nothing in the scheme of things, right? 100 employees, you're going to be paying them 10 or 20 million a year. You're far better off having some employees and getting a higher revenue. I mean, if it was 1,000 employees, that's not good, because that's going to cost you 100 million a year, and so your business is just treading water. But if you're paying less than 20% of your revenue on employees, there's no point in optimizing for fewer employees, because more folks are going to get you to cover more things, is going to be useful. And my favorite tool that I use now is Whisper Flow. So I type a lot of emails and Slack messages and WhatsApp. And so I hate typing, because you've got all the stuff in your head and it has to go through your fingers. It's really slow.
Right,
and
the bit rate is 100 words a minute, call it, if you're a pretty good typist.
That's right.
You can speak at 400 or 500 words if you're speaking very quickly. And you can think probably even faster than that. I don't know what the bit rate is of just thoughts, but it's much higher than that even. Yeah.
Exactly. I tried voice to text, Microsoft, the Dragon, the Apple, they're all rubbish. And then I came across Whisper Flow, and it's changed my life. I mean, over the last 19 weeks, I think I've dictated 520,000 words. And it tells me that 140 words per minute. I'm in the top 3% by,
and it kind of
my rate
learns
of speech.
as you keep dictating to it?
It learns as you dictate. It adds words to the dictionary. Though I have to say, and by the way, the reason for mentioning this is twofold. One, everyone should try it out. But two, because I think when I started, I was an early adopter. And I can see each new product release, they look like they're releasing one or two a week. Sometimes they just fix something that you've wanted. Sometimes you've messaged them. But even, I messaged them, this transcript didn't work, or hey, that would be great to have this feature. And there's a person there who obviously logs the feature request, writes back to me, sticks it in GitHub or wherever they do it. So they've got like extra humans. And I'm sure that they've just closed a $30 million round, I think. And so they've got obviously more people they're going to hire because actually it's useful to have some people.
So I got a quick question on this. So like my workflow, and I love to, you can tell me why Whisperflow is better, but my workflow typically is I'll copy the whole email chain into ChatGPT. Sometimes just download it as a PDF and drag the PDF in there, and then I'll dictate the response. Hey, we need to reply to Anthony, blah, 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 talk for, 20 seconds. And it spits out this, beautifully, crafted email. I read it and then I send it. And that's kind of been my workflow. But how does Whisperflow differ or is better than that workflow?
Well, I get an email or I look at a Slack thread and I know what I want to respond. And so I just begin talking. I just hold down Control-Alt on the keyboard and start talking. And then it does a pretty good job of getting it right. But what I love, two things about it. Number one, it's just way more efficient and more fun than typing.
It's the shortcut to voice to text.
It just does voice to text, exactly. The other thing is it's actually quite fun because you feel like you're having a conversation with the other person. My wife comes by and goes, it's weird as fuck what you do. You just, these random mini conversations with the computer. It's like, to do this, changes, add this to the cap table, then something completely different. These mini conversations, but it's like you're dabbling in all these little rooms. Does it pull the context
of the Slack chain in or the email chain in, or you have to do that manually? Or is
it just? I mean, I'm responding, to it. So I just go to the Slack thing and I just begin talking, and I hold down Control-Alt on the keyboard, and then it pastes the text into it. So it's quite transparent. And now, whenever I go to a computer that doesn't have this installed, it's like something's like fundamentally broken on my interface. I just want to I can't talk to this computer.
Yeah.
And there's an app for iPhone as well. It's currently pre-released, so you need to be signed up, and then you get the special link. And it's really good because I hate typing on iPhone keyboards, but now you can turn on the voice to text and just start, having a conversation.
So there is voice to text on at least Android. I use Android. I'm pretty sure iOS has the button, or at least on the Google keyboard, where you press the little button and just talk. But Whisperflow does a lot better of cogently translating your dictated voice into a cohesive response. Is that kind of the magic of it?
Exactly. It'll, put paragraph formatting. And if I say, I'll send you, $100, it's going to write $100. It's clever. Problem is, as they bring out each new release, I'm worrying that it's beginning to get a little too clever. And then the AI decides to rewrite what I'd said in a different way. It's like, dude, no, I just want you to remove the ums and ahs, work out when I'm backtracking. And that's one of the other things, right? Hey, Brian, I'd like to give you 100. Actually, maybe 200. You don't want the sentence to go 100, maybe 200. You want it to be smart enough to go 200. So it mostly gets it right. It's really clever. But then sometimes it decides, I'm just going to rewrite what you said. And it's like, no. I wanted, I'm in the legal tech business. When I say something, it needs to be exactly as I've said it. So I do slightly worry that it's going to be at some point the release is going to jump the shark and they're going to go, thanks, Anthony, for everything you're saying. I'm just going to rewrite it in this other way. It's like, no, don't, whatever you do. I want to dial back the amount of AI to fix the typos, but not change it into, somebody else.
What's fascinating about this is tying it back to our discussion on, on priced rounds. You think about the safe. It came out, almost 15 years ago now, and it was this artifact of a bygone time, right? And now you have AI generated docs and AI generated reviews of docs. And so you could see, and maybe you could talk about maybe what's on your roadmap and what you're seeing in AI document generation, but you could see a founder going, okay, yeah, I'm just going to do the pre-seed round. I'm doing 500 at 5 and it's going to be priced. And here are all the automated docs. Here's the summary of what all those terms are. And it's kind of cookie cutter, right? Because it's meant to replace a safe. It's very standardized in terms of there's 5 or 6 or 7 docs when you do a priced round, right? The stock holders
Exactly.
agreement, the
Yeah.
purchase agreement, et cetera, right? Maybe you could talk through what you're seeing, where you're seeing leverage in that area, and like kind of what do you see over the next year or two in that space?
So, I mean, most legal tech companies are started by disaffected lawyers who leave a law firm because they're technologists or they were frustrated with the time of doing documents. So they make AI for law firms. The law firm is still going to charge you the billable hour. They're just taking fewer hours internally. But it's a bit of a problem for law firms because if you go to a law firm and go, I've got this great software that where you charge 10 hours, you're now going to charge 5. They're going to go, sorry, what part of my business model did you just misunderstand? So there's a fundamental problem there. But some AI, legal tech is for consumers. So, I mean, SeedLegals, we haven't pushed AI because I don't believe people are looking for AI generated legal documents. They're just looking, actually, ultimately, they're looking for, I met an investor. How do I get their investment? Can you sort the process, which
Yeah.
starts with,
I don't need the drill. I need the hole in the wall, right? Is the old phrase.
That's right. Yeah. I mean, and that the process includes there's a pitch page feature, so you can create a pitch page and then you can share the link with the investor. And when they express interest, then you get notified and you can create a safe or add them to a round, and it does all the maths on the conversion and of the safes, and because no one knows how those YC post money safes, the arithmetic works. So I'm not pushing AI, but of course, AI is going to change everything. And there are lots of websites now you can go to. You go, I want a contract. So on SeedLegals, we've got a small number of contracts that startups need. There are lots of things we don't have. So if you go, I'm looking for T's and C's or a commercial contract, we don't have that. And so for me, this is a problem. You don't want to have built a business that disrupts others and then wake up one day and you've been disrupted by the next generation. So it's potentially a problem. So, of course, I check out all the AI generated contracts, but the problem is they're a frustrating experience for a few reasons. Firstly, a chat interface isn't a great interface for many AI things. So let's say you're doing a funding round and I send you a term sheet and I can send you a list of all the deal terms. That's great. But if instead, went, okay, Anthony, Brian wants to invest, great. What type of shares does he want? Pref shares. And what valuation does he want? I mean, after a while, it's like, dude, stop talking to me for 100 terms. Just show me a list of the things and show me a graph of what's market standard. So I think there's going to be an interesting change from chat interfaces to more appropriate interfaces to generate the docs. The other thing is, at SeedLegals, I'm hugely proud that we've taken something that lawyers would spend a week futzing around, and we take you through the deal terms and we build the document. But we still take the founder through the deal terms. And I've thought, should we just say, hey, Anthony, who's your investor? AI chat interface. Oh, you've got Index Ventures. Great. I'll build the docs for them. The problem with that is that I want the founders to go through all the decisions that need to be made, because I don't want them to have their car break down on the highway later. They open the manual, as in the funding round docs, and it goes, oh dear, I'm screwed because I did that. I want them to actually understand the things they're doing. So it's interesting, which is we could make the process simplified, but then we'd be like, you'd open the box and only then would you discover what you'd agreed to. So all of which is to say, I am building, in our roadmap, we're about to release actually AI, obviously for documents. So you can firstly have all your company documents on SeedLegals and then run, chat against it. Tell me, how much Anthony's paid, or when does the safe convert, or, how much do I have in the cap table, AI for your company, which I think is pretty cool. You can also upload pitch decks and we'll extract all the info from it and give you a summary. So AI is here to do a whole range of things. It will assist in building documents. And I think, just to wrap up on that, I think there's going to be the lawyer in the loop, as I call it, which is when, let's say you want a commercial license agreement with some other party, you can spend ages with lawyers describing to them what you want. But you can skip all that. Just go to ChatGPT. So I want a document that covers these things. It's probably going to give you a document that you absolutely do not want to sign as a legal document because there'll be egregious errors in it, but it will be 90% there for going to a lawyer and go, I tried this with ChatGPT, figure out all the things that are missing, figure all the things that are wrong, but it's only going to cost me 2 hours instead of 20 hours of billable time. And I think that's going to be the near future.
So back to the billable hour law firm.
Yeah.
Because you're not a lawyer, but you employ them. I mean, imagine 5 years out, are these law firms forced to change their business model, or do they just do more law than ever? And so instead of taking 10 hours to do that one thing, now they can do 10 of those things in the same amount of time. Are they constrained by demand for their legal services, or are they constrained by their ability to supply those legal services? And how do you think that whole industry changes with AI?
Great question. I obviously don't have the answer. I think there are a couple of parts to it. So firstly, the legal landscape is very large and wide, right? It's litigation and wills and probate, and some things are going to be ripe for changing. Commercial contracts will be the first thing to change because they're dispassionate. The parties want to consent together to get something done as opposed to being adversarial. And those will be the first. The litigation, I mean, AI will be used for discovery. Clinton's emails, 65,000 emails read 2 days later. Well, they didn't have 1,000 interns. They had some AI. So the change is going to be uniform across the way. But I think the other thing is, this legal tech is not my first foray in disruption over my career. I used to be with Kazaa, the music file sharing company. For those old enough to know that, once upon a time you bought vinyl, and then you bought CDs, and the music companies tried to sue out of existence the Napsters and everyone else trying to bring streaming music or downloaded music to the internet. And so the music companies defined success as selling CDs. They didn't define it as selling music or helping artists or even increasing revenue. It was selling CDs, and CD sales were declining, and they were myopic in not thinking about alternative strategies. And then I was with BBC, and we took the stuff on your TV, and then you could watch it where and when. So it was disrupting TV. But that was a broadcaster sort of disrupting itself. But then there's the Twitches and the YouTubes and the Facebook video and the TikToks now disrupting that. And so when it comes to legals, will lawyers or law firms, in a sense, disrupt themselves? Or will they only change when they're forced to change? And this is what I found over my 3 forays. The incumbents that are making a lot of money are not going to change until they're forced to change. Broadcasters still think, that YouTube and Facebook video and TikTok are just for kids, and when they grow up, they'll go back to watching television. It's like, dude, that's moved on. So I think, lawyers are only going to go so far with AI use internally and disrupt their own billable hours model so far, which is probably not very far, and will need either a new generation of law firm or platforms that use AI to create contracts are going to force a change. And then the question is, do law firms buy them, partner with them, disrupt themselves, or do they leave it for too late and whole new categories emerge where people just don't go to a law firm at all? And I think that's the bit that I see as what will happen, which is, in particular verticals, people will redefine success. Obviously, with SeedLegals, with fundraising. I mean, in the UK, we've done that. But when I look at divorces, for example, there are a number of divorce startups where, the whole, not only the divorce papers, but the allocation of assets and the negotiation is done in the platform. And then there are wills and probate, which used to be regulated and is still. Platforms can help there. And then there are going to be others for commercial contracts. So I think we're going to see, at least in, a few parties are consenting to do something together, we're going to see platforms with interfaces designed for those particular things, and they're going to offer like a $29 a month service instead of a $20,000 for a contract. And I think that's going to force everything to change, and lawyers and law firms may retreat into the things that are going to still need more humans, which is often going to be litigation and around that.
Yeah. I love that. Well, let's wrap up with a quick rapid fire.
Go for it.
A first line of code you ever wrote?
6502 microprocessor code. So when I was a kid, I used to code in machine code, in assembly, on Apple II. So I guess that dates me.
Hardest negotiation clause founders still underrate in 2025. Wow. Good advice. One UK regulation you wish America would copy tomorrow?
The tax breaks for investors, where angel investors can immediately tax deduct part of their investment from their income tax. It has fueled the UK startup economy. And, early stage fundraising in the UK is equal to France and Germany combined because of this.
Well, I would think that's a seeding mechanism, a seeding policy mechanism that will be renegotiated or removed eventually. I mean, some states have done that over the years in the United States, and eventually, once you get a critical mass, you're like, okay, we're just giving away money now. It's going to self-sustain. Kind of same thing with EV tax credits that are going to go away, right? You kind of get the market going, and then it's like, okay, the market's going. Let's take the incentive away.
And by the way, you may well be right. You want to create an efficient market. That, if you are competing for market share, maybe your state is competing with other states. Now Delaware competes with Texas and Wyoming and Nevada, and
yeah.
they've reformed the laws. It's fantastic to see competition, right?
Right. Yeah, states' rights. It is a very unique mechanism that we have here where you can be like, well, I don't like this state's regulations. Go to another state.
Exactly.
Yeah. So you get this like competition for, policy and ideas and economics. It's really great. What's a US only incentive besides 1244 that the UK desperately needs?
The UK government has been trying to pass some laws that make for more obligatory public reporting for companies. So in the UK, and your American audience would be horrified to note that in the UK, companies have to post their list of shareholders annually on Companies House, so they're public. So you can look at any company and see all its stockholders and the number of shares that they've got, as well as annual filings of the number of shares issued and so on. For a US company, this would be a huge privacy issue, right? So we know the SEC recently in the US tried to introduce the Corporate Transparency Act, so that you would have to file with them, not publicly, but with them, your list of shareholders. And then they got sued, and then they won, and then they got sued again. And eventually, it's still on the books in the US, to the best of my knowledge, but the SEC said, we're not going to enforce it, and the penalty for not complying is zero. So it was like a win for privacy. But in the UK, it's been going backwards. And so the government here passed some law that you have to not only disclose your list of investors, which has been done for ages, but also your company's annual profit and loss and accounting. And so there was a bit of a public outcry. I was part of it, and it looks like the government has rolled back on that. But I think the UK government needs to look at the privacy things in the US and how states compete with each other for business by offering more privacy. And it's a bit sad to see that I think we're going to have more UK companies setting up shop in Delaware because of some of these privacy and disclosure things that the government seems intent on pushing ahead with.
Bold prediction, by 2030, the average seed round will take what number of days to start to cash?
No different to today, because the problem is finding investors, and that's not going to change.
Well, let's assume you got all the commits, right? So you started on Monday, you got all the commits on Monday.
Well, I can tell you that answer because that's exactly what happens in the UK when people do price rounds on SeedLegals. I think it is 100 days from term sheet open, from people telling us they want to start a round to the round closed. And most of that is still the finding investors and the due diligence and so on. 100 days is quite a long time. And that's often an expectation management. It's not the time to do the legal documents. It's the time to get everyone on board. Funding rounds like the bus leaves with everyone on board, right? So the 100 days probably starts with the first person's on the bus, and like you've called the bus and open the doors, and now you go off then afterwards to find more. But the actual closing of a round, could be 2 or 3 days on SeedLegals for faster ones where the passengers are lined up ready to go.
This is why Americans love their safes, right? It's like their own automobile, right? You don't
Yeah,
have to get
that's
on the
what I
bus with
joke.
anybody else. I'll just drive my car.
The funding round's like a bus trip, and the safe is like getting an Uber for everybody. But
Yeah,
by
it's
the way,
funny.
you can still have vehicles. So we've got one in the UK, we call it instant investment. And that's essentially the basis for my safer products idea, which is a way of giving individual investors their stock without having to do the bus trip for everyone.
Well, this has been a fascinating conversation. I learned a lot. Where can folks interested, maybe founders, find you online?
Well, thanks. And I've loved this. It was a fun intellectual romp through a range of things. So you can find me Anthony Rose on LinkedIn, Anthony at seedlegals.com, or just head over to the SeedLegals website and hit the web chat and talk to one of my colleagues or ask them to connect with me.
Yeah, thanks so much for coming on. That was great.
And thanks, Brian. Thank you so very much for inviting me.